Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about market disruption and what happens next. Logan, welcome back to the podcast.
Sarah, your voice is a little bit low because you lost your voice somehow, and that means I'm going to do most of the talking. And look what happened. You left the country, and as soon as you got on that plane, all hell just broke loose.
It did. It was crazy.
And as soon as you got back, things have calmed down, So you missed quite an eventful few days here.
Okay, so tell me what the markets are doing and what that means for mortgage rates.
So this is Tuesday morning. Lord knows that after this podcast, there could be some crazy headlines and all hell breaks loose in this. But for now, it's calm. The market is calm. The 10-year yield got back to 4.35. As I talked to you, as of this second, the last thing I saw was 4.32 on the 10-year yield. Mortgage rates have now come down 3 different repricings to the lower side now. So we're almost about 20 to 25 basis points lower from what we saw on Friday. So the market is calm. What the hell just happened? Chaos. And what happens with chaos? Chaos is a very short-term event, and you could get really crazy out there and people make some really big, long, we were talking about how some bond traders were like soft marshmallows. They're like, nobody wants the US debt. Oh my God, it's spiraling out of controls. Where are the bond vigilantes? Where are they today? We're about to have like $10 trillion of debt coming on, tariff, inflation, all this stuff. And the 10-year yield is exactly where it should be, where it would have been on Jobs Friday if we didn't have the Godzilla tariffs. And now, as long as there's no crazy headlines or anything too bad, we could work off of economic data. Unfortunately, what happened is purchase application data was having a really good year in terms of, it's the first time that we saw year-to-date growth. By the time this podcast comes out, the data will be out to public to see how much damage that very sharp reversal did. But it was behaving better with mortgage rates at 6.75 this year than other years. So we're working our way back. Of course, if mortgage rates headed down towards 6%, sales are growing, everyone's estimates will be wrong. Yeah. Okay, that's given, but we're up here still. So it's a positive that this occurred. I mean, God, I had to bring out like a 40-foot eagle wearing sunglasses with me walking down the streets of Los Angeles to get people to calm down. And this does happen periodically from time to time. This was a very chaotic event, and it made the bond market go crazy. The day that you got to your vacation, one of the things that I said the night of Sunday was like, guys, one little word and it could be a face-ripping reversal and yields to the up. And we literally had that face-ripping reversal. But as of today, right now, mortgage rates are down, 10-year yields down. And as long as we could keep this calm atmosphere, we could work off the economic data. And that's how we should look at mortgage rates until chaos variables come back in again.
So let's talk about the larger economic thing. Are we still focused on inflation? Should we be thinking about that?
We got another one, Sarah. We got another Fed president to join Team Logan. Team Logan, labor over inflation. It's so interesting. It's the two hawks that have now gone to labor over inflation, where they were really highlighting inflation concern a few years ago. Now, both of them, Fed President Waller, one of our favorites, made a case yesterday, which I thought this helped the 10-year yield as well. He basically said, listen, if we're going to have a recession, I'm gonna highlight the need to help the labor market, basically, and I prefer having more aggressive cuts this year if that's the case. And if it is tariff inflation, like the Fed says, these are one-time price adjustments because it's so much bigger now, bigger than anybody imagined. And you don't know the retaliations, supply shortages, what's going to happen. All hell breaks loose in trade wars. But they believe that it'll be a one-time event, and then inflation, especially if it's a recession, will come back down because these are tariff inflations, not pandemic inflations or let's say an oil shortage that drove headline CPI inflation much higher. So The fact that now we have Bowman and Waller, two people that are in the up cycle now of their careers to be possibly Fed presidents. They both have gone Team Logan. That's three now. We're assembling an Avengers crew. Okay. And down the line, this means we could focus on the labor data. If the jobs data was bad the last 2 months, missing estimates like we saw kind of last year, then we could, hey, listen, that 10-year yield could go lower and lower. But where we are right now at kind of 4.32, who knows by the time you hear this, who knows what'll happen. This looks about right to me, and we could just focus on the economic data.
What's the next economic data that's coming out that you think could throw things a little bit?
So when we look at this monthly reports, retail sales, right? Housing starts, those are leading indicators where permits are going. Again, the labor data, I put that over everything. So we always want to keep a track of jobless claims, and then jobs week at the end of the month. The manufacturing data is starting to look like really bad. The New York Fed survey, which I don't really put much weight onto, like the new orders had the biggest collapse in like 20 years. And I think a lot of this is just perception, like nobody knows what to do. And this was one of our talking points about 2018 and 19. 2018 and 19 was a small tactical trade war tap dance. It had a much better environment to work. Trump waited for his tax cuts to happen to give a cushion. And even with all that, business investment went to zero. The backdrop now is more chaotic. This is why I question, if you're going Godzilla tariffs, you better get ready to make deals, because this can get worse and worse and worse. So we'll see. The marketplace to me is starting to believe that deals will get cut, and then eventually it'll just focus on China. But the clock is ticking. And you and I, before Godzilla tariffs, we said, bluffing or doing tariff on, tariff off for so early, you're forced to do something eventually, because you don't want to be called on the bluff every time. And as of right now, it's a better environment because the markets are calm, right? Stocks are up a little bit. Bond market is not acting up. This is like a good period of time if you wanted to make deals, if that's your attention, get it done. I know the Treasury wants to do some more deregulation to allow banks to hold more treasuries books. I would have typically done that beforehand, before getting into this. My opinion is that they were shocked by what the bond market did. And again, the stock market's one thing, but the mother bond market, you can't mess with that. But now, without really big interventions or anything, the 10-year yield is calm. We're back to where we should be. We just go off the data. And again, jobless claims each Thursday morning. We have retail sales, housing starts. The existing home sales market doesn't really imply to the economic cycle as much. The new home sales does, of course. Industrial production. There's a series of data lines that we track, and I encourage everyone, if you're confused about everything and your clients don't know what's going on in everything, 24/7 live Instagram, Logan Mohtashami. We have now almost 1 million people there a month now. We nerd out 24/7. I am not a fun, cool person. I literally do not do anything but look at economic data. If you want some explanation, I'm your guy. And with all the new apps and everything, we can do some really fun stuff with AI. But I get it. I totally understand how confused and shocked and scary it was for a lot of people, because now everyone's thinking recession, inflation, confidence indexes are all collapsing in a big fashion. We have to calm everybody down, get everybody focused, and then kind of take the next few stages of whatever this trade war tap dance will eventually be.
I keep asking you about a recession, and that's because it keeps coming up. Goldman Sachs, their percentage goes up. Other people talk about it. Tell me what you're thinking right now.
So before the year started, labor market getting softer, not breaking. We highlight the new home sales sector because residential construction workers are key. The residential construction workers, if I take the specialty trade portion of that, which is another data, that's already falling. So we're keeping an eye on that. The thing now is, because this was such a big shock to everyone, people are getting more and more negative. even some of my smart friends that wouldn't like, that are conservatives too, are flipping into the recession camp as long as this continues. So when you start with, before Godzilla tariffs, we said, okay, now they're firing government workers and they're withdrawing money. That in itself would raise the unemployment target higher. Okay. And the Fed, like we said, kept it low just in case for something like this to happen. They raised their unemployment targets. We're already there. Now with Godzilla tariffs, everyone's raising their unemployment rate targets higher and higher. New York Fed President Williams has it at 4.5% to 5%, has growth slowing down. All these things are shocks into a system that could have been handled better in 2018 and 19, but we just don't have that. So I think that was the wake-up call to the White House on the bond market, because as we have talked about, what does Trump want? He wants a lower dollar, check. He wants lower oil prices, check. He wants a lower 10-year yield, check. These things, when you put an economic shock that is negative, will all happen by themselves. So it isn't so much of a marketing line. They knew if they go into this, those things are going to fall. But he lost the 10-year yield, but it's coming back down. So we'll see how it is. I look at the weekly retail sales data. It's still showing positive year-over-year growth. We keep an eye on construction workers, but you can't keep on shocking the system like this, because, man, the negativity on some of these surveys are getting really bad. And the small business index is like 91% conservatives. And whenever Trump wins, that thing goes vertical. That's even falling down. So there has to be clarity soon, because the longer this goes, this is why everyone is raising their recessionary targets, right? I have to have my triggers first. So we don't even talk about that until the triggers are laid off. But it's totally understandable how people are upping their recession forecasts as long as this chaos continues and there's no clarity on what it is.
What do you see in the weekly housing data on the housing market tracker? How are you seeing this filter into that?
So the interesting aspect, you take all the madness, you take all the chaos. The existing home sales market was doing better than anyone thought. Now, you're not going to see this in the existing home sales report coming up, because our data is about 6 to 8 weeks ahead of the NAR. But even with the recent drama, the pending contract data was still positive. I would say the weekly curve slowed down a little bit. Purchase application data had its best week of the year, 9% week-to-week growth, 10%. But the new one today should decline. Every time you have a reversal in rates very sharp and you're working from a higher base, that data line always retracts back. That's why we do ebbs and flows and waves with economic models. So we'll see, because now rates are starting to come back down again. We just need to get everything calmed down and a little bit more focused. This is why I'm not a fan of Peter Navarro being part of Trump's team, because the markets don't take him seriously. And if you're going to flinch when the bond market goes against you, he might not be the best person to put on TV. But again, we don't know what other countries are going to do and how it goes. But to me right now, the fact that the market's calmed itself down, everyone's thinking there are going to be deals done. And still maybe the focus eventually be just China. But that's a lot of chaos. This is a lot. I mean, this is nothing like 2018 and 19. 2019 was small, rates were lower. There were all these other things that were in a better backdrop here. I mean, the Fed everyone's raising their inflation targets right now. That makes it more difficult for the Fed to cut rates. But Waller and Bowman have both said they're going to look at labor over inflation. I got two. I need two more. And then I could be Tony Stark. I get the Avengers going and we could run with this.
Any chance we see mortgage rates getting down to that 6% mark anytime soon?
You need the labor data. You need the labor data to break. So let's talk about that. The last two times mortgage rates headed to 6%, the end of 2022. Wow, the dollar was strong. Everybody was, going crazy. London was going to lose its pension funds. The Bank of Japan intervened. The IMF was going to send Ethan Hunt to take out the Federal Reserve because they were hiking rates too strong. that was a lot of market drama, and it sent the 10-year yield lower. And then the Silicon Valley banking crisis happened. So a lot of people thought, okay, this is it. And the Fed came in and cleaned up everything. The 10-year yield got to the Gandalf line. Sarah, we held that thing for eight tests. That's still crazy. Out of all the things in this cycle, to hold the Gandalf line on 8 different times when everyone was sure for a recession, reversal, not happening. Last year, 10-year yield went very, very aggressively lower. Labor data was revised lower. People are thinking the labor market's breaking. We got the 10-year yield to break the corridor. Labor data, that was all labor. That got us near 6%. Here, 435 looks about right because the labor data is just firming up, not crashing anywhere, getting it. But if those things start to break, now you got 2 Fed presidents talking about it's going to be, to me, it's very hard for the other Fed presidents to like not get on board with that. Because when job losses start to occur or jobless claims start to rise, it's going to be more problematic to say, well, we have to wait and see. And one of the things I've tried to stress is one of the reasons having a trade war in a democracy very difficult is 2-year political cycles. And if red states who are already getting government contracts withdrawn, who are already losing people that work for the government, if you start to get losses, job losses, the Republicans in Congress, they'll pull the plug. They'll take the control back on tariffs out there. So there, as we said a few weeks ago, Trump's got a little bit of a window. Whatever he's going to do, he's got to use that because, once that happens, it means all the things you did here are, going to go out the door in the next midterm cycle. So whatever it is, get it done. Markets are calm. Take advantage of it. It's harder to do stuff when markets get chaotic because people see your hands and they know when you'll flinch. And the bond market was the thing that made them flinch.
Logan, thank you so much for being on. Appreciate you as always, even with my voice crazy.
Even your voice, and just it was a breath of fresh air not being told what to do every day, and don't say this, don't do that, don't I? So I did enjoy it, but I am happy you're back. Because as soon as you left, all hell broke loose, and as soon as you got back, things have calmed down, right? And so everybody out there, market craziness happens here or there. Just kind of like keep that as a short-term thinking. Don't make these big, long, oh my God, the dollar's dead. Somebody asked me that, are we going to destroy the dollar to make Bitcoin the reserve currency? No, it doesn't work that way. So try not to take these people on YouTube's big macro changes about the U.S. And for God, Rayo Dalio is going to go off. It's calling us the Roman Empire. We're about to collapse. Do not listen to Rayo Dalio. Don't do it. Okay, that is like the doomer boomer of all time. Okay, just know we're not Rome. We don't have the Viscoughs and the Huns coming down. We already had our plague that we handled. This is the United States of America. We are the baddest ball players in the history of the world. And we're not going to crash like that in 2025.
Thank you, Logan. I'm sure everyone's very excited about that. No one wants to be the fall of the Roman Empire right now. So thank you so much. Talk to you soon.
Pleasure, Sarah.